All right, let's unpack this. Today we're doing a really deep dive into Welltower Inc. Big name, obviously. Residential wellness, healthcare infrastructure.
Absolutely. And the sources we've looked at, they show something more than just, standard portfolio management.
Right. It looks like they're completely rethinking their game plan for, well, the next decade.
Exactly. I mean, this is an S&P 500 company. They've got, what, over 2,000 seniors and wellness communities?
Yeah.
U.S., U.K., Canada.
Huge scale.
Huge. So you expect optimization, fine-tuning. But what we found, it's more like a full-scale transformation.
So our mission today, let's uncover the sheer size of their recent financial performance, through Q3 2025.
Yeah, analyze this really aggressive portfolio shuffle they're doing.
Yeah.
Selling one big piece, buying another.
And then there's this revolutionary change, they call it, in how they pay their top execs. Really long-term focus.
Extreme long-term alignment. That's the phrase that jumps out. It's not just your typical earnings call stuff.
No, it feels like they're surgically swapping assets and, maybe more importantly, shifting away from just thinking quarter to quarter. This idea of perpetual ownership seems key.
That's definitely the undercurrent. So maybe we should start with the basics. How the company's actually structured, how the core business did in Q3.
Good idea. Lay the groundwork.
Okay. So Welltower reports using three main segments. First, there's seniors housing operating, or SHO.
That's where they actually run the places, right? Share the risk and reward?
Exactly. They're in the operations, so higher potential upside, but also more direct exposure. Then you've got the triple net segment.
Landlord model. Just collect the rent.
Pretty much. Pure real estate leasing, fixed payments. And the third one is outpatient medical. Doctors' offices, clinics, that sort of thing.
Okay. And looking at the Q3 numbers, it seems like SHO, the operational side, is really carrying the weight now.
Oh, absolutely. No question. In Q3 2025, SHO brought in 57% of the consolidated net operating income, the NOI.
57%.
Wow. Yeah. Triple net was around 28%, and outpatient medical was the smallest piece at about 15%.
But the growth, that's a headline here, isn't it?
It really is. Look at the first 9 months of 2025. Consolidated NOI, basically operating profit, it jumped from $2.3 billion to $3.1 billion compared to the same period last year.
That's a 34% increase.
34%.
Yeah.
Huge surge.
A third more profit in 9 months. That has to be fueled by the operating segment, the SHO.
It is. SHO is, well, it's the engine. Its specific NOI shot up 47% year-to-date through September.
47% for SHO alone.
Yeah. It just shows how strong that post-pandemic recovery is, plus the impact of their strategic lies. It's really kicking in.
And you can see that recovery in the occupancy rates, right? That's always such a critical number in seniors housing.
Definitely. The sources show this really steady climb. They were at, 82.5% average occupancy early in 2024?
Yeah, sounds right.
By Q3 2025, they were almost at 87%.
That's a significant improvement across such a massive portfolio. Huge efficiency gain.
And that occupancy lift, plus rate increases, you see it in the SHO revenues, up 38% year-to-date.
But you mentioned acquisitions, too. It's not just filling beds. They're actively buying.
Right. It's calculated expansion. That Care UK deal, for instance, adding 136 properties, that directly feeds into that 38% revenue growth.
What strikes me is how they're funding all this. They seem incredibly well-positioned financially.
Oh, definitely. Their balance sheet looks rock solid.
Yeah.
End of Q3, they had almost $6.8 billion in cash.
$6.8 billion cash.
Yeah. Plus, they have their entire $5 billion credit line untouched, fully available. That's serious firepower.
That kind of cash position and low debt must make lenders happy, improves their credit profile.
Massively. The data shows their net debt to enterprise value, basically how much debt they have relative to the company's total value, it dropped sharply.
How much?
Down to just 8% in Q3 2025. It was 13% the year before.
Wow. From 13% to 8% in a year. That signals real strength.
It does. They're capitalized, they're liquid, and, well, they're clearly gearing up for big moves.
Which leads us right into that portfolio shuffle you mentioned. This is where it gets really interesting. Using that financial muscle to sell big and buy even bigger simultaneously.
It's a very deliberate asset swap, isn't it?
Yeah.
Let's start with the exit. The sale.
Okay.
They agreed to sell off a huge block of their outpatient medical properties, 319 of them, both consolidated and unconsolidated.
319 properties, what kind of price tag does that carry?
Gross price is around $7.2 billion. They expect net proceeds after debt and costs of about $6.0.
$7.2 billion. And they started closing that deal quickly.
Yep. The first batch, 123 properties for $2 billion, that closed in October right after Q3 ended.
Hold on, selling $7.2 billion of assets. That's one of their three main segments. How is that not a major strategic shift away from outpatient medical?
That's the fascinating part. The company explicitly stated they concluded this disposal does not count as a strategic shift impacting operations in a major way.
Okay. How do you square that circle? Selling off a whole reporting segment doesn't change your strategy.
I think the insight here is about capital allocation. They see outpatient medical as stable, yes, but maybe lower growth compared to seniors housing.
So they're selling stability at what they probably see as a good price.
Exactly. Cashing out at a premium valuation, likely,
Mm-hmm.
and then immediately redeploying that capital into their highest conviction, highest potential growth area, which is SHO.
So from their perspective, it's not changing the core focus, it's just optimizing the capital for that focus.
That seems to be the logic. Trading stability for potentially much higher returns in seniors housing. It's a bold optimization play.
Okay, so they get potentially $6 billion net, and they immediately put it to work, doubling down on seniors housing operating, especially, it looks like, in the UK.
Precisely. The timing is key. Right after Q3, in October, boom. 2 massive UK seniors housing deals announced or closed.
Let's break those down. The first one?
A huge portfolio buy for about $5.2 billion. That's what, maybe $6.5 billion US?
Actually, yeah, what was in that?
It was a mix. 111 properties managed under a RIDEA structure with Barchester Healthcare.
RIDEA means they share in the operational results, like their SHO segment.
Right. Plus 152 properties under triple net leases and even 21 properties still under development. A big, diverse UK bet.
And $5.2 billion wasn't the end of their UK shopping spree.
Not even close. Right after that, they snapped up the HC1 Group portfolio, another 279 properties, leased and owned.
For how much?
That one was $1.2 billion. But here's where the financial structuring gets interesting.
How so?
Part of that $1.2 billion trice actually settled an existing loan Welltower already had out to HC1, about $660 million, plus some equity warrants.
So they converted a loan receivable into direct property ownership. Less cash out the door for a huge acquisition. Clever.
Very clever. It structured a massive takeover while minimizing the immediate cash outlay.
So adding it up, these UK deals are huge. Over $6.4 billion combined. That's over $7 billion. Easy. They're funding this with the outpatient sale proceeds and borrowing.
Absolutely. Using that cash from the asset sale, plus leveraging their strong credit rating. They immediately issued $2.7 billion in Canadian dollar term loans in October.
Canadian dollars. Okay.
Yeah, that's about $2 billion US. Tapping different markets, ensuring they had the funds lined up to close these big UK deals fast. It's a classic example of using financial strength to seize a market opportunity.
Okay, so we've got the strong finances, the big strategic pivot towards UK seniors housing. Now let's talk about the people side, this executive compensation plan. It sounds radical.
It really is unconventional.
Yeah.
They call it the 10-year Executive Continuity and Alignment Program,
Yeah.
adopted in October 2025.
10 years.
10 years. It's meant to be the main incentive for their top 5 executives, the named executive officers or NEOs, for the entire next decade.
A 10-year comp plan in today's world. That completely changes the focus from hitting quarterly numbers.
That is precisely the goal. Get this. The 5 NEOs get a single, large, one-time grant of equity, these LTIP units.
Okay, big stock grant.
A very big one. And in exchange, they are not eligible for any other annual bonuses during those 10 years. None.
No annual bonus for 10 years.
Correct. The whole award is structured to be about 90% at risk,
Mm-hmm.
and it's 100% equity-based. Their personal wealth becomes directly tied to the long-term stock performance, period.
That's more than alignment. That sounds like golden handcuffs made of diamond. How does the vesting work to enforce that? Can they just cash out early?
See, that's where it's really locked down. For accounting, the units technically vest on the grant date. That lets Welltower book the expense now.
Okay, accounting quirk.
But for the executives, they cannot redeem those units for actual common stock until October 31st, 2030, at the very earliest, 5 years from the grant.
5 years before they can touch anything.
And even then, it's not a lump sum. The shares are then paid out in small monthly installments over the next 5 years until September 2035.
So 10 years total payout. Wow. The company takes the hit now, but the execs are locked in for a decade. That forces continuity.
It absolutely does. And it ties
Yeah.
right back to that phrase you mentioned earlier, infinite duration opportunity due to perpetual ownership. They're making leadership live that timeline.
Makes sense. Now, half of this award is performance-based. What do they actually have to do to earn it? The metrics must be tough.
Extremely tough. It's measured over 5 years, ending in late 2030. Metric 1. Welltower's total shareholder return, TSR,
Compared to what?
compared to a weighted basket of three major indices: the FTSE Nareit Healthcare Index, the MSCI US REIT Index, and the broad S&P 500 Index.
So not just beating other healthcare REITs, they have to beat the whole U.S. REIT market and the S&P 500.
Exactly. Massive outperformance is the goal. The bar is incredibly high,
What's the second metric?
hitting specific market capitalization milestones. But, and this is crucial, there's a safeguard. At least half of any market cap increase must come from the share price going up, not just from issuing more stock.
So they can't just dilute their way to the target.
Nope. And overall, Welltower's TSR absolutely must be positive over the period for those performance units to pay out at all. It demands real, sustained value creation.
This sounds expensive. A decade-long, equity-heavy plan for 5 execs tied to beating the S&P 500. What's the estimated cost?
The preliminary estimate for the fair value of these awards is about $1.3 billion.
$1.3 billion.
Billion. With a B. And they expect to recognize about $1.0 billion of that as a compensation expense just in 2025. It shows the scale of commitment they're making to lock in this strategy and leadership.
A billion-dollar bet on their own team and strategy. And meanwhile, they're still paying dividends to current shareholders.
They are. Underscores the idea that this long-term plan doesn't mean ignoring current returns. They just per share.
Which is what, about a 10% increase?
10.4% jump for the previous quarter. So rewarding shareholders now while incentivizing massive future growth.
Okay, let's try and pull this all together. What's the big picture narrative here?
Well, you've got Welltower aggressively reshaping its business, selling off stable, maybe slower growing assets like outpatient medical.
Right, cashing out big.
Then pouring that cash, plus borrowed funds, into huge acquisitions in their highest conviction area. Seniors housing operating, especially in the UK. That's the segment showing, what was it, 51% NOI growth in Q3?
Something like that, yeah. SHO-NOI was way up.
So massive strategic bet on SHO growth. And then underpinning all of it, they implement this truly radical 10-year executive comp plan.
Tying leadership's fortunes entirely to long-term market-beating stock performance, no short-term bonuses.
Exactly. It forces an incredibly long view. The takeaway for these documents is a company laser-focused on compounding per-share growth over many years, maybe decades, and achieving, extreme alignment between management and shareholders. That structure is built for that infinite duration opportunity.
That strategic commitment, locked in by the comp plan, is really the core insight. So here's the final thought for you, the listener, to chew on. We just talked about a $1.3 billion equity grant tied purely to 10-year success metrics. What happens to decision-making when the executive focus shifts completely away from managing quarterly earnings calls towards hitting multi-year market cap goals and beating the S&P 500?
Yeah, how might that actually change the way healthcare infrastructure investments are made over the next decade? Not just a Welltower, but potentially across the sector if this model catches on.
Especially when tied to that goal of perpetual ownership. How does taking away the annual bonus carrot and replacing it with decade-long equity handcuffs potentially reshape investment timelines for everyone involved? Something to think about.